Good morning, subscribers. Today we have Mr. Ajay Tyagi, Head of Equities in UTI Mutual Fund. Let me just introduce him to you. He is a CFA charter holder from CFA Institute USA and also a master's degree holder from Delhi University. Ajay joined UTI in the year 2000 and has successfully carried out various roles and responsibilities across the equity research, offshore funds, as well as domestic onshore funds. He has won many awards and accolades for his performance both domestically and globally. Ajay presently manages UTI's flagship equity scheme in India by the name UTI Flexicap Fund and is also investment advisor to UTI International's range of India dedicated offshore funds. UTI is one of the oldest fund houses in the country, as you all know, and today they manage more than 2,80,000 crores of rupees on behalf of all the investors all over India. Welcome, Ajay. Glad to have you in our channel. I'm sure that your insights will immensely help our subscribers.
Thank you, Chokalingam. Very excited to be part of this session today.
Thank you. And I would like to start from the latest happenings before delving into the details. So the thing is, day before yesterday, our finance minister presented the interim budget. And how do you view it? Because of that, yesterday markets were going up and up, although it was not a full-blown budget. But how do you view the interim budget presented by our finance minister?
Sure. See, I would say the most important aspect of this budget was fiscal consolidation. This was one lingering doubt in the minds of many global investors, which is that can India continue to be at a 6% or a 5.5% kind of fiscal deficit for long? Because this would obviously have had consequences in terms of our sovereign rating, and many global investors basically very closely track the ratings of the sovereign ratings of various countries before they invest. So I think the general mood of excitement in the market post-budget has been on account of the resolve of the government to continue towards the path of fiscal consolidation. The finance minister is reiterating coming down all the way to 4.5% over the next 2 years. And I think that's the most important takeaway from this particular budget. They were not populist in an election year, which is another good thing. They have continued to do sensible things like they have done over the past few years. And of course, like markets, economies too go through their own ups and downs. So economic growth can be weak in a particular year, strong in a particular year. But so long as you are keeping the balance sheet of the economy fine, the potential of India to continue delivering somewhere around 5.5–6% real GDP growth for the coming years, if not the full decade, is something that I would consider to be the base case, provided the policy framework remains fine. And to me, this discipline around keeping the balance sheet of India fine was my biggest takeaway from the budget. Yeah.
Okay. Good. So is that the main reason that markets went up yesterday? Yes, it's a short-term phenomenon, but I would like to, people like to know why the market went up, why the market went down. Is there any particular reason? Detailed points that you note from the budget?
Chokalingam, as much as we love to discuss about the reasons for markets going up and going down, I can tell you that all of this makes for a very good discussion around your evening drinks. But beyond that, it has actually no relevance. In fact, since you have given me and given UTI this platform to speak to your investors and the followers, I would just say, please zoom out and never try to decipher every move of the market, let alone one day. I would say trying to decipher the move over the next quarter or the next few quarters and so on. You see, we have to keep investments very, very simple. And the simplest way to understand investments and the simplest way to understand wealth creation is starting from the potential of the economy. And like I said, we consider the potential of Indian economy to remain very strong. Then coming down to those businesses which are going to exploit and ride on this huge growth opportunity that the economy is going to actually deliver over the coming decades. And in turn, as patient shareholders, we have to ride on such companies, be patient with them, hold on to them in the fullness of time, because these businesses will create economic value and therefore will create shareholder wealth. So, quite frankly, this is not something like a very philosophical thing that I'm trying to say to your investors, but this is my own, I would say, understanding of the last quarter of a century that I've been associated with UTI in different responsibilities as an analyst, as a fund of manager, now as a head of equities. You really have to zoom out. If you keep trying to understand each and every move of the market or of the share prices of the companies that you own, it's not going to, it's going to possibly negatively impact your wealth creation journey. So,
over a period of time, I do agree.
Yeah.
I do agree. But however, overall, the budget, whatever the interim, whatever, full-blown budget will be presented later. But overall, it is on the right direction. That's what your understanding is.
Absolutely. The government is continuing to do sensible things. The government is not being populist. The government is not trying to make political capital at the cost of the health of the economy. And that's why I would say it's a move in the right direction. It's a continuation of the way the present government has been thinking over the last many years. Yeah.
Good, good. And I'm taking the clue from your talk. What is your view for the next 5 to 10 years of Indian economy? Is it going to be very robust? Or, I mean, you mentioned around 5.5–6% of real GDP growth, but how do you view for the next? Because most of the mutual fund investors are focusing on 5-year, 10-year, 15-year horizon. No,
Yes.
Except debt funds, they are coming for 3 months, 6 months, 1 year. But now today, after the debt taxation, most of the funds are moving to equity schemes. People are moving, retail investors at least. So under such scenario, over the next 5 to 10 years, what is your thought process or observation how the Indian economy and the growth rates in general?
Sure. I think this is a very important question, because this will be the source of ultimate wealth creation for all equity investors. Let me start with the high level. Like I mentioned, our assumption is that the Indian economy should continue growing somewhere around 5.5–6% real GDP. Now, I must make this very clear here. Please don't get too excited if in a particular quarter the growth is 7.5%. Please don't get too despondent if in a particular quarter the growth rate is 4.5%, because this is very much par for the course for any market-driven economy. We are not an economy like China where the government tries to control everything. We are a market-driven economy like the US and some of the Western economies. Like equity markets go through their own ups and downs, any market-driven economy also goes through its own periods of, strong growth and weaker growth during the journey. On an average, 5.5–6% real GDP is what we believe is doable. Now, if that is the overall construct, and if we assume that inflation will remain somewhere around 4 to 5%, let's call it 4.5%, then the nominal GDP growth of the economy will be somewhere close to 10%. That's our construct over the coming decade. And if nominal GDP growth is 10%, I would say businesses on an average should be able to deliver somewhere around 11–12% earnings growth. I'm assuming earnings growth to be slightly higher, because if you talk about the whole economy as such, growing at 10%, you really, if you dissect, you can obviously find businesses which are growing slightly faster than the economy. The most efficient businesses, which form part of the top 50 or top 100 or top 500 businesses in the country, are a little more efficient than the economy. So 11–12% nominal earnings growth. And in the overall scheme of things, investors should therefore feel that this is the kind of long-term return that investors can attain. On top of that, you can add a dividend yield of maybe 1.5%. So one point which I must make, Chokalingam, here is that please don't consider a 14–15% kind of return to be the return which will always be there. As the size of the Indian economy grows bigger, the potential to grow will come down from 7.5% to 6.5%, maybe 5.5%, 6% as well. So there will be some element of a slowdown in the economy because the size is becoming huge. We are already the fifth largest, about to become third largest in the world. It's not, I would say, rational to assume that at a size of 5 trillion or 6 trillion, we'll continue growing at 7%. So that's the only minor adjustment that I would want investors to make in their models. But yeah, I mean, a 12% or a 13% return is a very, very healthy return.
Look, and probably, if I can say, if I can take the liberty to say, fund managers like you can deliver even more.
That's the endeavor, that over a full cycle, active managers can deliver 100 to 200 basis point higher. Yes, that obviously is the endeavor.
Yeah. And currently, at times there are sectors we say that are overvalued, some sectors that are undervalued. It depends. Of course, generally retail investors, everyone leaves it to the fund managers' discretion. They adjust it. But just for the knowledge sake, what are the sectors that you believe that are currently undervalued?
The most obvious one is the one which was the darling of the markets for many, many years together. I would say a full decade together, which is India's private sector banks. It is, quite astonishing for me to see how stocks like HDFC Bank, Kotak, even something like a Bajaj Finance has pretty much remained sideways, not participated in the rally at all over the last few years, despite these banks, delivering strong earnings, having strong return on assets, and profitability much higher than, the banking industry as a whole. So that's the most obvious one. Markets do provide us such opportunities, every now and then, when obvious stocks and obvious candidates for wealth creation are not found favor by investors and they continue to languish. So that is clearly one sector where, we are seeing opportunities. Apart from that, opportunities are there selectively across multiple sectors. So I would say that there are opportunities in India's pharmaceutical space as well. China Plus One is providing an opportunity for a few players who can actually be partners of choice for global pharma majors. So that's one opportunity that's there in the pharmaceutical sector. I would say that selectively, there are opportunities in the IT space as well. We are, to my mind, living in a IT age. Tech is going to touch the lives of all. The fact that we are doing this call today was something which was unimaginable till a few years back. So tech is basically touching the lives of everyone, and it is becoming important for each and every business that we talk about. And that's why IT companies are going to continue to enjoy reasonably strong growth in what I call as the IT age. So yes, opportunities across sectors, you just have to be a little more selective.
Okay. So prominent being the financial sector, private financial sector, banking.
Yes.
You mean, and the NBFC. Yeah. Okay. Good. And today, congratulations that you are managing one of the largest schemes in the industry, Flexicap. Probably more than 25,000 crore, a quarter lakh crore, if I can put it. So congratulations on it, and it has done well quite, for a longer periods of time. And one of the things that I want to, register here for our subscribers is UTI Mutual Fund is one of the fund houses which accepts applications from USA and Canada investors as well. Now that way, that people in USA and Canada are happy. Some of the schemes they could be able to invest in, UTI schemes. So the investors view Flexicap funds as one category, but there are within the category, if you see, there are different styles of fund management. Of course, SEBI has categorized as Flexicap. Okay, now the fund manager has the discretion to move from small cap, mid cap, or whatever. Then now comes the style orientation. There are within minute changes, of course. So, but however, when a normal person looks the returns, he compares one Flexicap scheme with another extreme of the Flexicap scheme. So now, can you elaborate on the same? If you can give some details about the scheme, the various different styles that are being done within Flexicap category. That would help our subscribers.
Sure. See, predominantly, there are three different styles that are there in the market. At one end,
sorry to interrupt, Ajay. If you want to use, you can use some presentation if at all if you want. Yeah.
Sure. I'll use that presentation as well. But before I show you some charts or some graphs, let me start by saying that predominantly there are three different styles that are there in the market. At one end of the spectrum is what we call as the growth style. Some people also use the words quality and growth interchangeably. So these are high quality, high growth companies, and there are certain funds and certain portfolio fund managers who would basically have a portfolio only of high quality, high growth companies. Okay. These businesses, by the way, are never cheap. They're always expensive. There is a reason for them to be expensive. But yes, these businesses also grow faster. They have stronger balance sheets and so on. The other end of the spectrum is what we call as the value style. Here, the fund managers would want to own businesses which are undervalued, which are out of favor of the market today, which may not have high growth prospects over the next 5-10 years because their industry is already at a mature stage, but maybe they are trading at prices which are lower than what the intrinsic value of the business is, and value fund managers try to capture this difference. Typically, what happens is that portfolio managers who are following the growth or the quality style would stick with their companies for long because, companies like Bajaj Finance or Asian Paints or companies like Coforge would continue growing at a healthy rate for many, many years to come. So therefore, you just hold on to these investments for long. Fund managers following the value style have a little higher churn because they try to find opportunities of mispricings in the market. When those mispricings are basically already exploited, then you try to look for some other pockets of mispricings. In between these two styles is what we call as the blend style. Here, the fund manager is agnostic towards these two styles. He tries to have a portfolio of a mix of value stocks and growth stocks. So predominantly, these are the three major styles that can be there. If you look at the Flexicap landscape in India, out of, let's say, 35 schemes, you would see about 5 to 7 being predominantly growth oriented. You would see another 5 to 7 being purely value oriented, and in the middle maybe you would see about 10 to 15 schemes which are a blend. So yes, there are different styles. As Indian market matures, I would say the styles will become very prominent. Right now, there are investors who only try to look at large, mid, small as part of the segmentation. But already advisors like you who are more nuanced do understand the difference of segmentation along the style curve, and therefore are already started to talk about growth schemes versus value schemes and so on. At this juncture, maybe I'll just try to show you a couple of charts if that's fine, and maybe also try to showcase how styles can vary over time. So if you can see this graph in front of you, what we have done here is we have basically tried to chart Nifty quality versus Nifty value. Like I said, quality and growth are used interchangeably. Nifty doesn't have a growth index, it has a quality index, and Nifty also has a value index, and both of them have been in existence since 2005. On this chart, what we've tried to do is we've tried to capture the 1 year outperformance of quality versus value right from 2006 till date. What you see here is that whenever quality outperforms value, it is basically shown in the blue shaded area facing upwards. Whenever quality underperforms value on a 1 year basis, it is shown in the yellow shaded area facing downwards. And as you can see, this pivot keeps moving from one to the other. Value does well for some time, then, quality does well, then again, value does well. And of course, value has done very, very well over the last 3 years, as you can see on the extreme right. This is the longest period of value outperformance ever in the last 17, 18 years of history. It also means that maybe value has run its course and, it should make way for quality or growth to come back. Now, Along with this chart, I also want to show you one more chart. This is slightly more detailed. So just bear with me for a minute before I explain how this chart is moving. Let's concentrate on the blue line first. Now, this blue line is showing the relative outperformance of quality versus value on a 5-year basis. So at any point of time, you look at the blue line, any point that you put on the blue line, it will be how quality has behaved against value over a trailing 5-year basis. Now, whenever this blue line is at the top, it is signifying those time periods when quality has significantly outperformed value over previous 5 years. Whenever this blue line is at the bottom, it is signifying that quality has significantly underperformed value over the previous 5 years. So looking at this chart now, in the last, let's say 20 years or 17 years, there have been 3 time periods when quality has significantly underperformed value. The current time period that we are witnessing, previous to that was 2017 when quality was massively underperforming value, mind you, on a 5-year basis as well. And previous to that was 2010 when quality underperformed value. Let's now shift to the orange line. The orange line is basically the future return. It's the prospective return. We know the prospective return because we have data going all the way back. So in 2010, somebody could have seen that, oh, quality has massively underperformed over a 5-year basis. I don't know what will happen in the next 1 or 2 years, whether the momentum of value will continue or maybe, value will now shift, momentum will now shift from value to quality. Actually, if you look at the orange line, this is showing the difference between quality versus value return over the next 1 year. While value did well, even on a 5-year basis in 2010, next year, quality outperformed value by 25%. The similar thing happened in 2017. While value continued to do very well against quality for quite a long period of time, but then from there on, basically quality outperformed value over the next 1 year by 40%. We don't have the data for this time period because obviously we're talking about future returns. So we'll get to see about this in the next 1 year. On the same lines, let me give you another chart. The blue line is exactly the same. We haven't changed the blue line. It's the same as in the previous chart. The phases when quality is massively underperforming value on a 5-year basis are the phases when the blue line is at the bottom. The red line this time is future 3-year return rather than 1-year return in the last chart. In 2010, after a massive quality underperformance over value, over the next 3 years, quality outperformed value by 30% CAGR. In 2017, after a massive quality underperformance, quality outperformed value by 30% CAGR again. Of course, we will get to know this data in the future. Now, last 2 slides for you, and these are very simple to interpret. We've seen those phases of quality outperformance, then, it moves to value outperforms, and then the pivot shifts back. If you look at the US markets and the global markets at the bottom, MSCI quality has already started outperforming MSCI value, and that too significantly. In 2023, there was a massive outperformance of quality versus value. In India, we are still seeing value outperforming quality, as you see at the top. So to some extent, the pendulum has swung to one extreme. It's refusing to come back and mean revert. We can never, be sure about these things. But yes, most of the charts and most of the data here is telling about how long the value rally has been. I want to show you one last interesting chart, which is that at UTI, while we're talking about UTI Flexicap fund today, which follows the quality growth style, but at UTI, what we have also realized with our experience of running money for so long is that you need to have a style discipline. You need to stick to your style, whatever that style is. And each style will go through its phases of ups and downs. There is no style which will continue outperforming at all points of time. I did show you that there were times when value did miserably, but then value is doing very well now. I did show you that there were times when quality did miserably, but then, in the future years, it recouped. On this table, we have shown the relative performance of each style in each calendar year starting 2011. I can share this data with you and your viewers can view it at leisure. The main point that I'm trying to give is only the right-hand side. The right-hand side, second last column is the return since 2005. And here you can see how returns converge. Despite each year being so different, you can see that Nifty momentum has given a 20.5% return. Nifty quality has given a almost 19% return. Nifty value has given a 17% return. Nifty 200 has given a 14.5% return. What it basically means is stick to your style. You will beat the market. You will have phases of ups and downs. And like, you've been seeing that despite values doing so well over the last 3 years, over the full time period, Nifty quality is still giving you an 18.9% return, which means stick with your discipline. In the long run, you will make money. If indeed your investors are having a horizon of 10 years or 7 years and beyond, all that we need to do is give them funds representing different market cap buckets, give them funds representing different style buckets, and then they just need to stick with them for long. They will be able to create returns better than the market so long as they patiently ride through the various cycles. Yeah. So a very long answer, Chokalingam, but I think this one answer along with data hopefully provides a context to all of our investors.
No, that is the exact purpose of this call with you, mainly, because most of the public, and even I can put, even the industry people who are distributors, who are advisors, they all get carried away immediately. Everyone sees the ascending order, descending order return, and then they say, okay, let us switch the fund. That is the review people do most of the time. So this is the exact reason, I wanted to have you this call, even at a tough time for quality. So that is the exact reason. Now, anyway, you have mentioned all, in detail about the presentation. If you are done, you can close the presentation. Now,
sure.
I would like to you to elaborate on your fund management philosophy, which I have heard you many times. Now you are a strong believer in quality and how it outgrows, how it creates wealth, etc., etc. But I want you to share your thoughts and philosophy here of the Flexicap fund management side that you follow in UTI.
Sure. I'll just keep the presentation on because I have 2 more slides on our philosophy and how we run it. So you're absolutely right. UTI Flexicap is a firm believer in buying high quality businesses. And I will take a step back as to why do we think quality is important. I think, of course, experienced advisors and investors like you already know this, but maybe our viewers have also felt it, but they're not able to imbibe that and internalize that in their investment philosophy. The simple phenomena that you, me, and many of our investors have observed is that there are only a handful of companies that end up creating wealth. The Pareto law is applicable to every field of life, investment included. Only a select 10-15% of companies end up creating wealth. So that's observation number 1. If only very few things are going to create sustainable wealth, then why actually try and catch every trend of the market? Then why to try and catch momentum every time, because that momentum keeps changing. So that's point number 1. And if that be the case, then what are these companies which end up creating wealth? And that's where we realize that the one characteristic common through all of these sustainable wealth creators are businesses which are high quality. Therefore, let's define high quality objectively. And the objective definition of high quality is businesses which have high return on capital, businesses which generate strong cash flows, businesses that have neat and clean balance sheet, businesses that are not leveraged. These are the essential ingredients of all high quality companies, of companies which have created great wealth for investors over many decades, whether in India or outside of India. That's our starting point. Before we realize how strong the business is, how sustainable the business is, how strong the balance sheet is, low to no debt with which the business is operating, we will never actually proceed. Once we have done that, then we come to the next thing, which is how strong how strong is the growth runway for the business? Is the business going to continue growing? Is the industry penetrated already, or is it largely under-penetrated? Because if it's under-penetrated, then growth will continue for years and years together. Growth is important for us because we are really talking about making money for our investors, not by buying cheap and selling high, not by exploiting mispricings. We are trying to make money for our investors by holding on to a great business, that great business growing its franchise, growing its business, creating more economic value, compounding that economic value, and this compounding of economic value leads to compounding of shareholder value. So we are investors who are basing the entire wealth creation on the outcomes of the business that we are owning, rather than what the market would want to favor or disfavor. Where are the trends today? Would investors want to buy oil and marketing companies? Would the investors want to buy PSUs today, or would the investors want to buy maybe let's say pharma sector? We're not looking at those trends at all. We are only looking at what the business can deliver, looking at its history, looking at its balance sheet. We are wanting to understand how strong is the growth potential for this business in the fullness of time. Once we have established these two things, we then make an investment like the promoters of the business and say that, look, let's just stay invested in this for the next 5-7 years, maybe even more than that. And as the business keeps creating economic value, it will get transferred into market value, which as shareholders we'll keep enjoying. So Chokalingam, that's basically our framework. We want to be business-like. We don't want to, interpret the stock market moves. Yeah.
Good. So, and now from now on, as you say, as you see, is it the bottom of the quality, or how long? I mean, I understand that purely. I understand that no one exactly knows when certain style will pick up. So I am 100% sure. The only thing that I'm asking you here is probably you may be better informed or better well educated than an ordinary person in guessing the things. It's just your opinion, how long it might take from here for the growth style to make a comeback.
Sure. And therefore, this chart in front of you can obviously give you an idea. You're absolutely right. Nobody knows, and certainly I don't want to profess as if I know, when would the style shift. But you see, this chart is telling you a story. This chart, if you look at it, is already telling you that value has delivered very well for very long this time, much longer than the previous cycles, much longer than the previous cycles. And therefore, there is a case for the pivot to shift, the pivot to move back into quality. When does that happen? I would say it can happen, as of tomorrow. It can take another 3 months. But yeah, I mean, this chart along with this chart is already telling you that whenever the markets whenever the blue line reaches to the bottom, which it has done, already maybe more than 6 or 7 months back, the next 3-year returns will pivot towards quality rather than continuing towards value. It's a very, very clear chart, tested at least thrice in the last 17 years. This, along with the previous chart that I showed you, is telling you that it's overdue. When does this happen is a bit difficult, but Chokalingam, we always try and teach discipline to our investors. And therefore, it is incumbent on us also to just stay disciplined rather than trying to be extremely edgy about, let me try and time it, let me see when it will work. The data is telling you that, yes, the time is ripe. When exactly the pivot moves, it will come unannounced.
No. Yeah, I agree. Only post-mortem we can do when it
Correct.
happens. Anyway, that's good. And so now to the more pointed or pertinent question. So now, since the quality is at the bottom and you are managing one of the, you are a more quality advocate from UTI Fund House. So is it good time to add money to Flexicap?
Sure. In fact, that is what we've been suggesting to our investors, that because of the massive underperformance of quality over the last 2-3 years, this is already a good time. And I'm all let's be very fair. There are cycles that happen. In 2020, I know many of the investors felt that there is no better way to invest in the markets than quality. Value stocks were beaten down. I know a few fund managers who were practicing value with their own discipline were massively underperforming. But look what happened after 3 years. There was a time when people were exiting the value funds. I don't want to take names, but I think it's only obvious to everyone. People were exiting value funds because they were frustrated with the last 3 or 4 years. But to those fund managers who stuck to their discipline, they just reaped the benefits, and more importantly, their investors reaped the benefits over the next 3 years. So same is the case here. Obviously, because of the massive value underperformance and we staying the course with our discipline, we feel excited about our prospective returns. I did mention to you, if I look at my own top holdings, the businesses remain as strong as they ever were, whether it's an HDFC or a Bajaj Finance, but they have actually not participated in the rally at all. They continue to be one of the best businesses in India. And therefore, I remain excited about the amount of wealth creation that can happen over the next 3 years if I stay patient with these businesses. And quality across the board, not just in banking and financial services, but across the board has underperformed. And that gives us this confidence that, we just need to keep doing the same thing. Markets will change their mood. When they change their mood, like I showed you in those graphs, things will change dramatically. Yeah.
Good. Thank you. And one more, question, connected to that. So, because people are now already afraid that markets are, at a peak, so it's overvalued. So now the question is bulk investment okay into these quality type of funds right now? Maybe UTI Flexicap fund or any of these.
No, Chokalingam, here my answer would be that we are still advocating SIPs. And the reason for SIP was there in your question itself. Markets are overvalued. There is no shying away from that. So while relatively quality is undervalued against the market, but if the markets were to correct, I don't think I want to give an impression that the markets will correct, but the quality stocks won't correct at all. They will correct significantly lower than the markets. That's the nature of high quality businesses. But given the overall valuation of the market today, I would only suggest to our investors, please do SIP even in the quality or growth schemes that you are wanting to own in your portfolio. I think at this juncture, that is the most prudent way of increasing allocation into equities.
SIP or STP? Probably.
Yes, absolutely. Yeah.
Probably that comes to the end of my questions, generally. And just to, always people are interested to know the personal details of others. So it may be hobbies, it may be likes or dislikes, whatever may be. There are people in the industry, who might be following you on LinkedIn or elsewhere. So would like to know what you are kind of a person like, what do you do, etc. So whatever you want to share, I'm not going to put any particular question. Whatever you want to share, you can share.
Sure. So Chokalingam, I would say that everybody has hobbies. In my case, my biggest hobby is at least twice a year, try and go to the Himalayas to find peace within. And my favorite holiday destination, in fact, my wife and my kid keep complaining that, we hardly travel outside of India on a holiday, but my favorite holiday destination is either Himachal or Uttarakhand, going to a remote location and just doing nothing but, watching nature all around, going for long walks in the morning and evening, and just trying to, read a book, during the day. So that's my hobby, and that's what I wish to do, wish to do even more after a few years when I find more time to myself. That's pretty much hobby number 1 to 5. Post that, the other hobby is listening to music, which pretty much happens, uh, you know, uh, every day, just to, unwind. Yeah, I mean, I would say these are the 2 big hobbies that I have.
Good. Thank you. Probably now I request subscribers to put your questions here. So, Ajay Tyagi is here and directly he can answer your queries. You won't get such opportunities to directly interact with, large fund managers, generally any fund manager. So here there is an opportunity. I request to put your questions here. Just a minute, Ajay. Let me go to the YouTube and see the channel. People from Kathmandu are attending. Okay, Satish Valvekar. I mean, anyway, you answered this question, but he has put why the Flexicap fund is not performing. Previously, it was #1 fund. That is the thing. You want to say something? You answered already, just as brief.
Sure. Sure, Satish. So, like we explained, we are following our style of investing into high quality and high growth businesses. Like I showed you in the charts, quality as a style has underperformed in the last 3 years, and that's the reason why our fund is underperforming. But let me assure you, we are still owning the same great businesses that we always have owned. And our confidence on these great businesses delivering and creating shareholder wealth remains as solid. We are sticking to our discipline, and we know that at some stage, this discipline will be rewarded, and we will end up making strong returns for our investors. So just be more patient. These cycles can really test patience, but the quality of a great investor, whether it's an end investor like you or a fund manager like me, is to be emotionally very stable. This is a business where more than your intelligence quotient, your emotional quotient is always the quality that leads to great results. So we just want to be very, very emotionally balanced at this stage when things are working against us. We just want to be very rational as to questioning our portfolio in terms of whether we have done wrong stock pickings, or is it just that the mood of the market is very different. And the answers that we are getting right now is that the mood of the market seems to be very different right now, but the businesses that we are holding are still fine. So yeah.
Okay, thank you. And then Vijay Desikan, as this being an interim budget, what would be the main focus when the main budget is presented in June, July? Is there any indication from the finance minister?
See, I would say if the government comes back to power, and there's all likelihood of the same government coming back to power, then the main budget will not be too different from this budget. They've already committed themselves to a fiscal deficit number, so they can't, play around too much with the balance sheet now. They can't be populist, and they don't need to be populist once the election is over, by the way. So I would say, don't expect two different outcomes. Even in 2019, the final budget was not different from the vote on account. So I mean, this time as well, it should be very similar.
Okay. And then Durai Swami, UTI mutual fund managers information are very good and useful for new investors and existing people. Thank you both. Okay. Joseph, is it okay to invest in pharma E's or whatever? Pharma ETF is pharma ETF or pharma fund?
Yes, it is okay to invest provided your time frame is at least 5 years. The pharma sector has already seen a very strong performance over the last 1.5 years. To expect that this performance will be repeated over the next 1 or 2 years is not a rational expectation. Pharmaceutical businesses and healthcare businesses do provide very strong opportunities, both from the perspective of healthcare trends in India, as well as, like I mentioned, being a part of the export opportunity as well. But all sectoral funds and ETFs are extremely volatile. And we typically invest into them when we look at their last 1 year, 2 year returns being very, very strong. So I know why this question is coming. Yes, pharma as a sector should do well. There would also be a period of consolidation, maybe some negative returns. If you can withstand that, then you can invest in this sector. But I'm just cautioning you, it's not going to be as strong as what we saw in the last couple of years. Your expectation should temper down.
Okay. Yeah, that's a very good answer. And of course, this is an individual stock question. So, but however, I will convert that question. So his question is, what is your outlook on HDFC stock? Will the pressure on in ease, will its large balance sheet post merger affect its earnings going forward? Would this be a good time to accumulate HDFC? So let us not get into a stock specific question, but however, you can, I will present this question in a different format. Is these private banking businesses, are they facing challenges? You know, banking or NBFCs as a sector, you know, PSUs are, you know, doing well, and these banks and NBFCs are facing challenges. You already mentioned in your thing, but what is your outlook generally for this sector? I mean, subsector or whatever you call it.
Chokalingam, our outlook is very, very clear. The trends of the last 20 years will be repeated. The magnitude could be different. Private sector banks will continue gaining market share from public sector banks. Whatever we have seen of public sector banks over the last 2 years is more on account of the cleanup that has happened in their balance sheet, but their underwriting standards and quality will remain subpar. The last 4-5 years in general has been a very strong phase for the banking sector in the country. In such environment, you obviously expect everybody to see lower stressed assets and non-performing assets. Whether that will remain true when the cycle turns bad is to be seen. Our view is that when the cycle turns bad, private sector banks, basis their stronger underwriting skills, will perform significantly better. And in any case, the ability to gain market share from public sector banks is also not going away. The magnitude may slow down of market share gains, but it's not going away. And valuations of these private sector banks, like I mentioned at the beginning of this conversation, are at multi-decade lows. So there is absolutely no reason to extrapolate the strong price performance of PSUs into thinking that PSUs are better managed entities now compared to private sector bank. Nothing can be farther from truth. Yeah.
Okay, thank you. Then another question from Kailash Srinivasan. It is stock specific question. He is asking about Paytm. Hello Kailash, we are not authorized to speak individual stock here, neither he nor I. So sorry about it. And Sarvaraju is asking again a stock specific question. If he invests in HDFC Bank Corporation, we can't answer a stock specific question. Suraj Patel, lump sum schemes, hybrid versus equity, outlook over next 3 years. Hybrid versus equity.
That's a very interesting question, Chokalingam. At this stage, when we see that the markets are clearly overvalued, we've been suggesting our investors that hybrid schemes make more sense. A balanced advantage fund or a multi-asset fund is certainly making more sense compared to pure equity schemes, because if markets correct, your downside protection will be more in balanced advantage funds or hybrid funds today. And the other good thing is that when markets correct, we automatically would increase exposure towards equities. So, it's a scheme which goes contrary to the market. And at this stage, clearly lump sum investment should be directed towards hybrid schemes. That's the message. Yeah.
Sure.
While you can keep SIPs and STPs on in equity schemes, but any lump sum clearly goes into BAF or MAF.
Okay. Then now there is a question from Raidaraj Yakula. Can you explain the banking financial sector opportunities in India penetration for the next 5 to 7 years?
Sure. I mean, at the high level, if I talk about penetration, then India's household debt to GDP is just 40%. And this 40% has remained in the same ballpark for more than 15 years now. And this number has continued to increase for a lot of other emerging markets. Now, what this number is telling us is that the growth in banking credit in India is not because households are leveraging themselves more. The growth in household credit in India is because the economy also has grown, and in lockstep with the economy, households have taken leverage. So they are not over leveraging. They are leveraging only to the extent of growth in their own incomes. That actually just gives us this confidence that it's not an overheated financial sector. Two, the possibilities for penetration still continue to remain. Credit growth will keep percolating down while the bigger cities and towns have enjoyed the benefit of credit being available. So whether you and I have to buy a car or have to buy a two-wheeler or have to buy, let's say, a big LED TV, we have enjoyed availability of credit. That has not been there in smaller towns and cities to that extent, smaller towns and villages to that extent. The next 10 years will be about percolation down to the next strata of the Indian population. So that's why we remain excited. That's as far as credit is concerned. Apart from that, there is a financialization of savings that's happening right now. People are moving out of real estate, gold, and fixed deposits towards different instruments like mutual funds, buying insurance policies, not for savings, but buying insurance policies to protect and buy a term plan, to buy a medical insurance. So, all of these things will also help the larger, banking conglomerates, which are a full service house, which apart from banking, also have asset management, insurance, non-life insurance, and so on. Yeah.
Okay. Anyway, for the sake of time, we will take 2 to 3 questions and then we will conclude this session. Now, as you have some other things also. So now, Bhupati Devarajan, as the market is keep on increasing, is it right time to invest or wait and watch for some time? Will there be any correction this year? If you want to take, you can take the question.
See, very likely there could be a correction this year. This is the valuation of the market. But the one thing that we have always learned is don't wait for timing the market. And that is why we say that SIP, STP is the best discipline. And the only nuance is that when markets are overvalued, make your SIP into a 12 to 18 month SIP if you have to invest an amount. If your markets are really undervalued, that's the time when I would say a lump sum investment or putting your investments over the next 6 months is the most sensible thing. So if you have a pool of money which has to be invested at this juncture, I would advise 12 to 18 months. If you are already invested into equities and you are in a systematic manner making some investments out of your salary every month, just continue with that discipline. Don't stop it. Yeah.
Okay. Good. Then I think Manikandam Palanivelli is from Singapore. The trend in the past few years seems to be more favorable of small caps as an aggressive investor to stay invested as an aggressive investor to stay invested in Flexicap on SIP for long term rather than fixed small cap or act by trend. I'm not very clear with the question, but the thing is, he is asking, the small cap versus, the large cap story and all those things.
Sure. And I'll just show you a chart on small cap versus, or rather on small caps, which should tell you where are we in the cycle right now. This is basically the valuation of small caps as of today. I'm sorry. This is the valuation of small caps as of today. On an average, over the last 11, 12 years, they've been trading at 14 times. Today, they are trading at more than 21 times. This is significantly higher than long-term averages. So while I know there is huge amount of excitement about small caps, but please be mindful of the valuations at which they are trading. This is the chart for mid caps. And this we have all the way from 2006. Mid caps are trading at a valuation significantly higher than their average, even higher than what they experienced in 2007 before the big correction happened. So be mindful of these things. There has been a lot of money chasing mid and small caps, because of which valuations have really gone overboard. And we are telling our investors to be cautious about them. We're not saying stop your investments, reduce your excitement about them. Your portfolio needs some amount of rebalancing because small and mid caps have done too well. Rebalance your portfolio, bring them back to the original allocation. Maybe you need to just prune down some exposure into mid and small and put that money into large. Yeah.
Okay. Thank you. One more question then, and that will be the final. Okay, this is the last question. Again, Suraj Patil. IMF chief recently appreciated reforms by central government in the last 10 years, especially digitization, GST, Aadhaar-based transfers. Any insight?
Sorry, Chokalingam, I didn't understand the question.
No, he is saying IMF chief recently appreciated reforms by central government of India in the last 10 years, especially on digitization, GST, Aadhaar-based transfers, etc. He is asking, do you have any insight?
Yeah, I mean, the insights obviously are in a way very evident to all of us. GST implementation has led to rationalization of taxes in the country, has made the system much more efficient. We don't have, a bar of soap selling at one particular price in Chennai and another price in Bombay. So there has been rationalization, which has helped corporates. Tax evasion because of GST has gone down significantly. And therefore, tax collections, which have been very buoyant, are helping the economy. These same tax collections have been used by the government to roll out social programs. So, for basically the same level of economic activity, tax compliance has improved. The same tax compliance is helping do more by rolling out certain social infrastructure schemes, which in turn is then again helping the economy. As far as Aadhaar-based transfer is concerned, I would say Aadhaar was basically the bedrock for creating the entire financial stack that we talk about, the entire digital stack that we talk about. Needless to say, how UPI has basically helped transfer of money and made it more frictionless. There is massive advantage because of Aadhaar in terms of tax compliance. So, these are the very, very long-term things that are now helping the economy in terms of improving the productivity by individuals and corporates, improving tax compliance, and therefore improving the quality of our growth. So, the advantages of this will continue coming to us for many, many years and decades. Just yesterday, I saw the news of France wanting to introduce the UPI system. So just imagine the amount of attention that India has got by introducing the digital stack. And even advanced countries like France are now saying that, look, we want to use your UPI system. So, I mean, this is a multi-decade benefit that will flow through the society. I just hope and pray that the government is working on many such more reforms which help improve productivity of the economy. I want to end the discussion by saying GDP growth is a function of three things: increase in labor, increase in capital, increase in productivity. All of the efforts of economists are ultimately down to these three variables. Productivity is the most important because there is no end to productivity gain. Human ingenuity will ensure productivity gains. The Indian economy over the last 10 years has, using human ingenuity, shown a lot of productivity gains. Digital stack is one of them.
Thank you, Ajay, for the last 60 minutes or 75 minutes, even before that, you joined. Thank you very much for your insights, and I am pretty sure this will help, the overall mutual fund investors and UTI investors, UTI customers, and also those people who have invested large money in UTI Flexicap fund with your style and energy levels and with your insights and knowledge. Thank you once again for participating on, and giving your precious time to our subscribers. And of course, this session will be on YouTube recording, so people can view anytime. Thank you once again.
Thank you, Chokalingam.
Nandri.
Okay. Thank you, Chokalingam. Very nice having this session with you.
Sure.
And yeah, hope to meet you at some stage.
Yeah. Just